right, we're still trying to work out how to buy the best in property regardless of market cycle. We know the market we're buying in, we know the suburb we're buying in, now we're getting down to where the rubber hits the road, being investment. The next one we've talked about, we're going to talk about is the low cost to hold. Now, understanding most people when they buy property, they think of blue chip areas. The trouble with blue chip areas is that the capital required to buy a blue chip property compared to the rent received means it's far too expensive to hold that property. Now, smart investing is about using the least amount of money out of your back pocket to hold the most asset possible. So that comes down to the equity you put into it, but also the amount of money out of your pocket to hold it on a weekly basis, so the cash flow required. Ideally, and in today's market, today's interest rates, if you're putting in 20%, you've got a cash flow positive property. So you can get cash flow plus growth, and people shouldn't argue, or there shouldn't be a sales tactic used about negative gearing or cash flow positive property. You should get both. You're allowed to be greedy when it comes to investing. But understanding as a percentage what your property costs to hold is really important. Now, if you're using OpenCorp, property investment specialists, the consultants will outline, based on your situation, they'll go and find a property and secure that for you before you've signed any contracts or gone through it. They'll provide you what's called a property investment analysis. Now, this outlines a 10-year projection on the property, inputting your personal data and that specific property's personal data to give you an exact amount of what you're going to get back in tax from the government and the out-of-pocket expenses required to put into that property, or the cash back into your pocket that that's generating for you. Now, 90% of clients currently are getting huge amounts of money back for every property they purchase, so it's great times, and will be for quite some time yet. But to understand the percentage as far as the rental yield, the calculation, which is my for you as a property investor, is a trick. If you get your iPhone, and I use my iPhone, if you turn the calculator function on, then turn it sideways. It opens up a huge amount of additional functions. You'll need this to work out the rental yield equals the weekly rent times 52 divided by the purchase price times 100. So if you're going through this calculation, for example, if the rent's $460 a week, the value is $630,000, then the rental yield, $460 divided by the weekly rent times 52 is $630,000 times 100 is 3.8%. So once again, really simple to follow in my for the property investor, but understand the least amount of money you can take out of your back pocket to hold a portfolio gives you more money to use on the next investment and the one after that and the one after that.